Hello, in this video, we'll be going through the statement of cash flow operating activity using the direct method, part 2. This video is going to jump right into where we left off in part 1. So if you haven't watched that, please do so because this is just a continuation of that video. So we've discussed the cash received from customers and we've covered all of our income items on our income statement. And now we're going to move on to the expense items on the income statement. We're first going to go through the cash paid to suppliers or cash paid for inventory. Our income statement tells us that our cost of goods sold is $1,200, and then we have to look at the related operating balance sheet items for cost of goods sold. There is going to be two balance sheet items that when we record cost of goods sold, these two balance sheet items are the ones impacted. First is inventory, right? Because when we sell our inventory, we debit cost of goods sold and credit inventory. And then a lot of times when we purchase our inventory from our suppliers, we don't immediately pay cash. Oftentimes we're going to pay on credit, and then probably 30 days or some amount of days later, we're going to pay them in cash. So we're going to look at our inventory account. Our inventory account decreased by $30 and our accounts payable increased by $50. So let's see how we can convert this cost of goods sold number into a cash paid for inventory amount. First, we're going to look at our T counts for each of these balance sheet accounts, and we have our beginning and ending balances for each of them. And we're told that our cost of goods sold is $1,200. Which means that when we debit cost of goods sold for $1,200, the other side of the entry is a credit to inventory for $1,200. So when we look at our inventory, it begins with $800, and then we have a credit for $1,200. That does not equal $770, which means we've made some purchases during the year. And we did. We made purchases for $1,170, and that's a plug. And when we do that, when we made the purchase from our suppliers, we debited inventory for $1,170, but we did not pay cash. We're going to assume we did not pay cash. And our accounts payable is, we credit our accounts payable $1,170, which is going to take us to our T account, which had $190 beginning. Then we increased it by our purchase, our credit for $1,170, which does not equal $240, which means that we must have had a debit to the accounts payable for the cash payments. And that debit is a plug, right? So now we have a debit to accounts payable for $1,120 and credit cash for $1,120. So this amount is a plug, and the purchases amount was also a plug to make the balance roll forward. So our cash paid for inventory, $1,120. Let's do this the journal entry way. The journal entry is we're going to start with our cost of goods sold per our income statement. And when we increase an expense, we are going to debit it. So cost of goods sold debit $1,200. Then we look at our balance sheet items related to that cost of goods sold amount. And we look at the inventory is 30. So I'm sorry, the inventory decreased by 30. So a decrease in an asset is a credit. So we're going to credit our inventory by 30. Our accounts payable increased by 50, right? It went from 190 to 240. Increase in liability is a credit. And then our plug to make this journal entry balance is to cash. So it's a credit to cash for $1,120. And credit to cash means an outflow, which makes sense because we are calculating the cash paid for inventory. So we had an outflow for inventory. Alternatively, you can also use this type of method where we take our cost of goods sold per our income statement, right? So because it's an expense, and we look at our related balance sheet account and we see that our inventory went down. So here, when we have a decrease in operating assets, then we reduce that expense by that amount. So here's my minus $30. And then my accounts payable increased by $50. So when I have an increase in my operating liability, I'm going to decrease my cost of goods sold amount. So here's my decrease of 50, and I can get to my cash paid for inventory for $1,120. Concept check. Determine how much was paid for inventory during the year. Our cost of goods sold is $900,000, and then we have our beginning and ending balances for inventory and accounts payable. So before we go on, why don't you try to do this on your own using what we just learned? First, our inventory increased by $35,000, went from 130 to 165, and then our accounts payable increased by 12. It went from 23,000 to 35,000. So let's build our journal entry. Our cost of goods sold is 900,000, so we have a debit for 900,000. Our inventory increased by 35,000. It increased in an asset as a debit, so we're going to debit inventory for 35. Our accounts payable is a liability and increased, which means we credit accounts payable for 12,000, and then we credit cash, which is a plug to make the journal entry work, and that's going to be equal to our cash paid to suppliers. So we're going to move down our income statement. We've done all of our revenue items and we've addressed cost of goods sold. The next two items are the depreciation expense and amortization expense. These are non-cash items and they have no effect on the cash flow. And so basically we just don't report it on the statement of cash flows using the direct method. So we're going to cross those out. Our next expense is salaries expense. So let's look at that. Our cash paid, how much should we pay in cash for salaries? Our salaries expense was $300 per the income statement, and the related balance sheet account is salaries payable. So we look at our prior year and our current year, and we see that our salaries decreased by $40. We had a $60 balance and it went down to $20. Let's go through our T accounts. Here's my salaries payable T account, beginning 60, ending 20. We're told in the problem that salaries expense is 300, which means that we recorded debit salaries expense, credit salaries payable. So here I have my credit to salaries payable. If I look at my T account, 60 plus 300 does not equal 20, which means I have some sort of payment for salaries that happened during the year. And that payment is $340. This is a plug, okay, to make this T account work. So the cash paid for salaries, I would have recorded debit salaries payable, $340, and credit cash, $340, right? That's my cash outlay. Again, let's go through the journal entry of how to figure this out. My salaries expense is a debit of $300. My salaries payable, the related balance sheet account, decreased by 40, and a decrease to a payable to a liability is a debit. So I would debit salaries payable by 40, and then I would have to credit cash for $340 to make a balance. Again, the cash balance is it's a plug to make the journal entry work. So here again, my cash paid for salary, $340. And then my third way of calculating this is taking my $300 using this little cheat sheet per my income statement. I had a decrease of $40 on my balance sheet, and using here I go decrease in operating liability. I'm going to add that decrease, so this is going to be a plus 40, and again cash paid for salaries $340. So concept check. Determine how much was paid to employees during the year. I'm going to debit my salaries expense, $700,000. Look at my change in my salaries payable between my beginning of year and end of year, and this went down for $25,000. And a decrease in salaries payable is a debit. So I'm going to debit salaries payable 25, which means I need a credit to cash for $725,000, and that represents the cash paid to employees. Another item that could be on the statement of cash flows is the cash paid for insurance. Let's go through that. And that's the next item on our income statement. So now we're slowly moving down the rows. And so insurance expense, we had insurance expense for $70. So here's my $70, right? That's the snapshot from the income statement. And the related balance sheet account this time is going to be a prepaid insurance account. So it doesn't always have to be a liability when it's an expense. oftentimes for insurance purposes and rent purposes, items are prepaid in advance. So here we're going to look at our asset account prepaid insurance and see that it went from $60 to $80, so it increased by $20. Let's do the T accounts. First, our insurance expense is $70, which means we recorded debit insurance expense 70, and then we just assume the full amount went to prepaid. So we're going to credit our prepaid account for that expense by $70. And now we can't make it work, right? 60 minus 70 does not equal 80, which means that we had another prepayment made during the year. And that's a plug. And we made a prepayment for $90. Again, that's just a plug. So we debit prepaid insurance for 90, and the other side goes to cash. So our cash paid for insurance is $90. Let's do the journal entry method way. Our insurance expense was $70. So I'm going to debit insurance expense 70. My prepaid increased by $20, right? This year, increase in asset is a debit. So I'm going to debit prepaid insurance, $20. And then I have the plug to cash, credit cash, $90. So my cash paid for insurance, $90. And then the third way you can do this is using the cheat sheet. Here's my expense, my insurance expense from my income statement. I had a $20 increase to my prepaid, which is an asset. So increase in an operating asset. I'm going to add that increase. So I'm going to add that 20, and there's my $90. Next item on the income statement is loss on sale of equipment. Loss on sale of equipment, similar to depreciation amortization expense, is a non-cash expense. It is because this resulted from a sale of equipment. If we receive cash, right, for the sale of equipment, then that would be cash inflow under the investing activity section. But the actual recording of the loss is a non-cash item, and it's not reported under the direct method on the statement of cash flows. Now, next, let's look at cash paid for interest. Same thing, right? On my interest expense, it's the next item on my income statement, is $10. So here's my interest expense. It's $10. And I look at my balance sheet. And if you look at the balance sheet that is in the beginning of the slide deck for this example, take my word for it, there was no interest payable, okay? So there's no interest payable, which tells me that this entire interest expense was a cash payment. So our cash paid for interest is $10. If I want to do the T account method, my interest payable, since there was no interest payable on the balance sheet, that means the beginning and the ending balance was 0. So during the year, we debited interest expense for 10 and credited interest payable for 10. So at some point during the year, I had a credit balance in my payable for 10, but I must have paid it off because my ending balance is 0. So my cash paid was 10, and I would have debited interest payable for 10, credited cash for $10. And if you want to do the balance sheet, the journal entry method, we would debit insurance expense for 10. There are no balance sheet accounts to account for. And so the other side of the entry is just the cash plug for 10. So either way, any method you use, the cash paid for interest is $10. Let's go through a concept check. Interest paid to bondholders is reported in connection with a statement of cash flows as what? So this is for bonds that we as a corporation issued. So we sold bonds, right, to the bondholders, right? In exchange, when we sold those bonds, we get money. When we got that cash inflow, when we sold those bonds, we have now a bonds payable on our balance sheet because now we owe money to those bondholders, and a bond payable is usually a long-term liability. And so long-term liability gets recorded under the financing activity section. So when we received the money for the sale of bonds, that went into the financing activity. Now, as part of the bond, we will pay our bondholders the principal at the end of the term of the bond, But we also make interest payments, right? And we have to record our interest expenses, our interest payments. We have to record interest expense. Our interest expense won't necessarily be equal to our payments, but that's not for this video. So, but we have to record interest expense. Our interest expense ends up on our income statement. And if it ends up on our income statement, then it's going to be an operating activity. So even though it's a bond, interest paid to bond holders, which was the initial inflow of that cash was financing, when we pay them interest, it's going to be an operating activity because we record as interest expense. Okay. Last item is cash paid for income taxes. And voila, we have income tax expense on our income statement for $40. So let's look at to see how we're going to treat that. So we have income tax expense for 40. Our related balance sheet account is income tax payable, which went from a balance of 50 to 30. So we had a decrease in our taxes payable for $20. Let's look at our T accounts first. Here's my T account, my beginning of 50, ending is 30. I'm told that my income tax expense was 40. So I'm going to assume that the entire amount went to income tax payable as a credit. So this is that credit here. So when I roll forward my T account, my 50 plus 40 does not equal my ending balance of 30, which means I had some sort of a payment. And that's the plug, right? The $60. So I would have debited income tax payable for 60 and credited cash for 60. So my cash paid for income taxes is $60. Let's do it the journal entry way. The journal entry way is I was told that my income tax expense is 40. My related balance sheet account is the income tax payable, which went down by 20. A decrease in the liability is a debit. So I'm going to debit income tax payable by 20. And then I have a credit to cash, which is just the plug. Again, cash paid for taxes is 60. And then my third way is taking my income tax expense. You can look at the cheat sheet that, with the orange coloring that we used before. And when you look at a decrease in the operating liability under the expense side, it tells you to add back that decrease. So I would add back that 20 to get to $60. Now let's look at what we're finally done with our income statement. We've addressed all the income and expense items on it. Let's see what our direct method operating activities section looks like. It's going to say cash flows from operating activities. And here's all of our cash inflows from customers, right? This is the revenue we received in cash for $1,760. We earned $10 in investment revenue in cash. And then we had these various cash outflows for inventory, salaries, insurance, interest, and income tax expense for these different amounts that we just went through in this video. And then you just add all those up. So this is all plus minus all my outflows. I have net cash flow from operating activity equals to $150. So that's how you do the operating activities using the direct method. Let's compare that to the indirect method. Indirect method, we started with our net income per the income statement, adjusted for the non-cash income statement items, and adjusted for changes in our operating assets and liabilities. And guess what? We got net cash flows from operating activities for $150. Let's go back to the direct. $150. So either way should result in the same net cash flow, either inflow or outflow from operating activities. That your total amount shouldn't change. It's just the presentation of how we got there. And there's very few companies, like I said, that actually use the direct method. CVS is actually one of the very few companies that does show the direct method. And so this is from the textbook, but if you want to go into their 10Ks, their most recent 10K, at least the one I looked at, they still report it using the direct method. Exxon used to report it on the direct method. And again, when you do the direct, you have to do the indirect method as well. And so at some point, Exxon stopped doing it using the direct. But CVS still does both. So you can see the cash receipts from customers, cash paid for inventory, insurance benefits paid, cash paid to other suppliers, interest paid or interest investment income received, interest paid, income taxes paid. And then they have their net cash provided by operating activities. Let's just look, and they list it for 3 years. Let's just look at this 2023 column at the very end, right? The net cash provided by operating activities is 13,426. Now, again, they have to report on the indirect method as well. And look at the 2023 year, it's 13,426. So I'm just showing you once again that whether you use the direct method or indirect, the total, the net cash provided or used by your operating activities will be the same.